The whole goal of this webinar, the whole goal of where we're at, it's September 30th. We're moving into October, November, December, January, February. And that's slow season. Lower cash flow, lower revenue, your operating expenses, at least your fixed are probably staying still, but you're now decreasing revenue, the whole thing. And so I wanted to bring you on to go, everybody's got their own business. They're going to run their business their own way that's best suited for them. And you guys, that's your encouragement. This is your business. Run it your way that's best for you and your life, your business, your goals.
The company doesn't have that cash to redistribute and put into assets, right? And so while it's super important to have trucks, obviously as a moving company, using debt can really handicap your growth, oddly enough. The biggest cost of any company, and it's invisible, but the biggest cost of any company is the cost of potential, right? And so if you're paying 15% of sales to administrative payroll, you have a lot more potential that those administrators can produce for your company than you're currently using. You know that if you go into the winter season with that cash balance, you're probably going to be just fine, okay? You're going to have enough cash to get through that. If you don't have enough right now, if you don't have 1.75 times that overhead cost or that overhead expense, then you really need to figure out how to clean up your company because you may not make it through the winter.
My man, there you go. Brock, welcome. Hello.
Hi. What's up?
Hi. I haven't seen you in a long time.
Yeah, been a whole, what, 4 days?
Yeah.
3 days?
Welcome, everybody. All right. We got people already filing in. Man, we talk about Inc. 5000, fastest growing companies. We talk about sales, and some people show up. But man, we want to talk about cash flow and P&Ls, and the great people show up. So grateful for you guys joining us today. Thank you so much. And oh man, am I excited to get started. There's a lot of cool things happening. First off, I've got to show off. The weather is shifting here in Arizona. So we've got our door open at our office, which gives some natural light. So I'm very excited about that. And that's all I wanted to share there. Some stuff. Everyone, I've got Brock here. I'll introduce him officially in just a second. Brock, feel free to say hi.
Hi. What's
Hi. I'm so excited. We have a lot of fun together. And Brock, what was I going to say? Oh, admin stuff. Admin, for those of you joining, I'm very excited for y'all to be here. I want you guys to engage. Brock specifically said, I want people to ask questions. I want to be as valuable as possible. So get your questions ready about P&L, cash flow, debt, anything when it regards to finances or running a P&L. Get that ready. We've got two places you could submit this at. Place number one, the webinar chat. In the chat, we'll have people monitoring it. You can just submit your questions there. That's one place. The second, more ideal place, at the very bottom of your screen somewhere, there's a thing called Q&A, and it's a perfect place to put in your question and answers. Put in your questions here, submit them, and it gives me a nice cue to ask Brock. So that's going to be my ideal, but you can do the chat. In the chat, there is a blue button that says everybody, or it might say host and panelists. You must change it to everybody so everybody can see it. So if you guys can do this for me, everyone say hello with the everybody so that the chat goes to everybody. Let everybody know you're here, you're listening, you're ready to go. Yanis, well done. Reese, well done. Kyle, thank you. Kyle again. Jason, well done. Lance, Nason, John, Luke. Prob, welcome, Prob. I just met Prob. That man is a cool dude. And he laughs at some of the things I do, which I appreciate even more. Russell, Charlie, Ashley, hello. Kirk, look at everybody did it. I don't think there was one person that messed it up. Let's see if we can go 100 for 100. William, hello and ready to go. That's what I like to see. All right. Well, let's, for sake of time, for honoring everyone's time, let's jump into it. We got everyone. Hello. I'm so glad you guys are here. Derek, I'm so glad you are here under Lauren's account. I love it. We're gonna put that down. So we're gonna jump right to it. We are live from Queen Creek, Arizona. Here we go. Can you guys see my slideshow here? Can we see it? I need a yay or a nay. I got a yes. I really couldn't see the chat. I was looking for Brock, and Brock was saying nothing. So,
oh, sorry. Shoot.
All right. Well, let's get into it. We're
My
5
bad.
minutes in. We're going to go and talk about how movers can manage cash flow, break even, and plan for stability. But I want to start. Who knows who this is? Who knows who this is? Does anybody know? Put in the chat. Brock, you can't say it. I already shared this with you.
Well,
The
I can at least
queen.
derive McLaughlin,
Yeah,
right?
McLaughlin. Her name's Sarah McLaughlin. No.
Yeah, something like that. Yeah.
She
Yeah.
she was in the 2016 Rio Olympics, and despite her feeling sick, battling a cold, lacking of energy, she ran a phenomenal time at the Rio Olympics. I think it was the 400 meters, and she did so well despite her conditions. Why do I bring it up? It's because I'm feeling a little under the weather. So if you're thinking, Travis, you look a little tired, you sound a little sad, it's only because I'm fighting a sickness, and you can just compare me to an Olympic medalist and an Olympic gymnast. This is who I am today, guys. So, but everyone, thank you for being here. We've got Brock. Brock owns and runs ProMover Accounting. He is the man, the myth, the legend when it comes to finances, business development, when it comes to business decisions, cash flow. Like this guy is the dude. And so I'm excited. Brock, thank you for being here today.
Absolutely, man. Thanks for having me. We always have a good time when we're hanging out. So
We have fun. Maybe we'll
yeah,
turn this into a podcast one day.
deal.
But
Yeah.
well, I'm grateful for being here. I want to just start this up and ask a few questions before you get into your thing. I got Derek under Lauren's account saying I like the Cherokee in the background. So let's talk airplanes later on. But thank you, Cherokee 6 right there. I have a question. I wanted to just roll right into this and
Okay.
get everyone's brains flowing here. How I want to talk about debt real quick. Let me just get rid of my screen here. Have I gotten rid of my screen sharing? Yeah, great.
Yeah. Yeah. Yeah.
I want to talk about debt.
Debt. Okay.
I get conflicting insight. I'd love your insight as we go into the winter season, taking on debt. When is it good to take on debt? I've had the two stories. I've had the moving owners who have sold and they go, man, I wish I took on zero debt and I wish I would have grown a little slower with zero debt. And then I hear the other side of people who are like, debt is how I grow and it's how I grow
hmm
fast. Give
hmm
us your insight, your stories,
Yeah.
your P&L analysis, your smartness on this. Give us your insight and then we'll roll right into everything else.
Yeah. Yeah. Well, debt is a tool, right? Like everything else, and it is a tool that makes you very vulnerable. And so I historically do not recommend debt and except for as a last resort. And usually we can really go down a rabbit hole on this, but usually the reason I don't love debt is because a lot of times debt is needed because a company has an appropriately appropriated funds for the purchase of capital assets, right? And usually what that means is, and this is the issue that really it's the issue of issues, is moving company owners take too much draws out of their company, right? And so their company is short on cash, but they need to grow and they want trucks and they want to own their trucks, so they get
Draws
debt.
meaning, hey, money left over and I'm going to pull it out so I can pay my bills, go on a family vacation, buy a new truck, get new tires, like that kind of draw. Okay.
Draws as in, yes, I'm going to take it as an owner's draw. So owners, right? Any entrepreneur knows that there's three ways you get paid, right? You get paid in a W-2 wage as an employee of your company, right? As all S corporations should and such. Number two is you take draws out of the company, which is as your company builds up value in cash, it's called retained earnings, right? Well, when you pull that equity out, you're siphoning off some of the value of your company, right? It's like you're selling off stocks, kind of, right? The third way then is appreciation. So the value of your company appreciates, cash flow appreciates, and the multiple that you could sell a company, appreciates, right? The bigger you get, the more that can be. And so when moving company owners take more than they should, and they take money out of the company and they take it in equity, the company doesn't have that cash to redistribute and put into assets, right? And so while it's super important to have trucks, obviously as a moving company, using debt can really handicap your growth, oddly enough, right? And I say that with a caveat of I would rather not take draws and use cash that the company earns and that's in the company to redistribute into buying fixed assets. So what we usually recommend is the first and the best of the cash goes to paying down debt, right? Any debt you have, pay down debt. Next, buy assets to continue growing, and then finally take it as draws or dividends as you need, right? Debt's very much a tool, but to really nail this and put it into some numbers. I know a lot of the people that mentioned something in the chat or said hello or whatever, and I know a lot of them know some of this stuff already. So let's get into some of the numbers, which is we do not recommend debt in excess of 15% of annual sales. And the reason that we put that threshold on there is because at about 15% of annual sales, that interest and paying on that debt usually can eat into about 3.5% of the cash flow of the company. So if you have a 10% net operating income, which we can get into, you're already eating 3.5% of that just on that leverage, right? The interest on that leverage. So we don't always recommend it. We would way rather have cash purchases, but I also understand that it's a valuable tool that you can use to grow. And which is something else we can talk about, almost universally, with some exceptions, it's more profitable to finance a truck than to lease a truck. Almost universally, and we built a template that we plug numbers into to kind of test that. But unless you're paying an outrageous amount for insurance or the repair and maintenance is a lot on the trucks you own, usually it's more beneficial to buy trucks. And if you can't buy it with cash, then you buy it with debt. So debt's a valuable tool, but we don't want it to get out of hand. And also to tie that into valuation, I shouldn't say valuation because in the moving industry, valuation is something very specific. To tie it into a company's valuation, if you sell your company, before you get a check, you got to pay the debt off, right? So that's where it can really impact the cash earnings of a company when they go to sell. Is you don't get to just pocket $2 million if you sell your company for $2 million. You know, obviously the debtors take their portion. Uncle Sam takes his portion. Yeah. And you're not left with $2 million.
Okay. That's great. I have a few more questions on that, but I do want to move on and we'll wrap that back in. There's I did ask, you said you have a template on this. I did say, who wants to see that? We got a couple of people saying yes. So maybe afterwards, by gunpoint, I can force you to maybe share that with me and we can share that to people. I got some fun ways we can do it. So, okay.
Absolutely.
Well, thank you. That's very generous of you. You heard it here, folks. He's going to do it. So moving on, the whole goal of this webinar, the whole goal of where we're at, it's September 30th. We're moving into October, November, December, January, February. And that's slow season. Lower cash flow, lower revenue, your operating expenses, at least your fixed are probably staying still, but you're now decreasing revenue, the whole thing. And so I wanted to bring you on to go, everybody's got their own business. They're going to run their business their own way that's best suited for them. And you guys, that's your encouragement. This is your business. Run it your way that's best for you and your life, your business, your goals. But I'm somebody who loves to get wisdom. I want to get wisdom to get other people's insight to help me make better decisions in my business. That's why we're here today. So I wanted to go through cash flow into the winter season, wisdom behind that. And so I'd love for you to kind of take it away. I know you've got some stuff to share. I'll interject with questions, but bring us your wisdom going into the winter season, cash flow, and drop your mic here. I'm ready. We're all excited.
Okay. Yeah, we'll get into that. So anytime I'm talking about that projections or what to do with cash or how to make sure that you're going to maintain through the winter or whatever, I always have to mention that cash is the oxygen of the company, right? Cash is the reason that you have a company. You don't have a company purely for the appreciative value of that company, right? Tech companies a lot of times are that way, where they don't have cash flow, they don't have earnings, right? But they do have an increase of appreciation of the value of the company. Moving companies are not that way. Moving companies are pretty much solely valued on the cash flow that moving company generates and the company's ability to operate without the owner. That's something else we can talk about. But cash is the oxygen. So if we want to have a healthy company, we need more oxygen. We need more cash, okay? And thinking about going into the winter, a lot of the times I want to start with this mindset in April, right? Because in April is when we're beginning to build up that cash balance, right, leading into the winter. It's very difficult to build your cash balance in December, right? It's much more easy to build your cash balance in June, July, August, right? Before we get into the slower season. And so with that in mind, usually what we like to think about is how much cash do I need right now to make it through the winter, right? There's some of you guys that have a healthy cash balance right now, and because we're finishing up through the summer, and you realize, hey, you know what? We were just talking about trucks and debt and things, and you're like, hey, you know what? I could go out and buy a truck with cash. That'd be great. Potentially reduce some of my lease expenses and things like that. I want to be able to focus on growth and so on and so forth. But before we make any decisions like that, we want to take a step back and say, how do I go into the spring? How do I go into April? And I have the cash that I need to make sure that I'm going to be able to sustain. And not only that, we want to thrive, and we want us and our family to sleep well at night in February, hopefully not having to scrounge around to cover payroll, right? And again, this mindset kind of starts in April, right? But now we're in the last days of September, and so now what? Okay, so two ways that we can look at this. And the second way, I'll share my screen and kind of talk through actuals, but from a 30,000 foot view, this is really how we consult with bookkeeping clients. And it's basically that we look at what the average overhead cost is per month in a company, right? So whatever your overhead cost is in your company, our clients, you can pretty much look at your total expenses, and they should be relatively similar throughout the year, unless you have substantial growth or there's some unique one-offs and things like that. If you look at your costs, or what we would call overhead, that's going to be roughly similar month to month. And
Wait, Brock, when you say cost, we're talking about fixed costs, or are we including variable in this as well?
Overhead costs,
things that are not changing month to month for the most part.
You got it. And you know what? Actually, maybe I'll share my screen right now and kind of walk through what exactly that is, especially for my clients that are on here that can kind of see where we're looking. So this is am I sharing my screen?
Yep, and zoom in if you can on the screen. Can you guys see this okay? I'll
zoom in here real quick.
Insight here. Let them zoom in and then answer the question.
Okay. There's a lot of data, so Adobe's freaking out here on me. Okay. Yeah. So
more. There, can you go right
there? All right?
There you go. Can you guys? Looks good. Good. Looks really good. No, guys. Can you see the screen? Not me here. Can you see the screen here? Looks good. No, I just got a looks good, Brock. All right, there you go.
Okay, good. Okay, so especially my clients whose income statement is set up like this, which all of our clients are very similar other than sales and some advertising breakouts and things. If you look at total expenses, this should, for the most part, be very, very similar month to month. Now, this company is kind of an exception because they had substantial growth the past year, but in total, it should run about even, okay? What we like to do is say, okay, using that information and is running about even, we want to take the average overhead cost per month and multiply it by a factor of 1 3/4, right? So take the average overhead cost, multiply it by 1.75. That's going to give you what we call a recommended minimum cash balance, or on our financial statements, it's the cash balance target, right? We call it the recommended minimum cash balance.
So if I have $100,000 in fixed costs, I'm going to go 1.75. I want $175,000 in this balance.
You got it. That is what we call the recommended minimum cash balance. So again, from a 30,000 foot view, without digging into the actual numbers of like what do we plan, forecasting what's going to happen. From a 30,000 foot view, the down and dirty back of the napkin number is to look at this number, to calculate that number for yourself. Again, what is the average overhead per month multiplied by 1.75? And that cash balance is the recommended minimum cash balance. And that's our target. Okay. If your cash balance isn't there, hopefully it's there right now because we're coming through the summer season. Let's hope that it's there. If the cash balance isn't there, your entire objective for you as a moving company owner is to get to that cash balance. You shouldn't focus on anything else other than getting to that cash balance, or whatever it takes to get to that cash balance. Okay. Once you're at that cash balance, now you know that through the winter season, when your cash is degrading a little bit through the slow season, you're putting 3 guys on a 2-man job, you're kind of burning through a little bit more cash through the winter just to keep your guys and whatever. You know that if you go into the winter season with that cash balance, you're probably going to be just fine. Okay. You're going to have enough cash to get through that. if you don't have enough right now, if you don't have 1.75 times that overhead cost or that overhead expense, the average overhead expense, then you really need to figure out how to clean up your company because you may not make it through the winter, right? So you need to figure out how to maintain your margins or increase your margin, but predominantly massively reduce your overhead costs. And not only that, you're not taking any draws, you're not paying any extra on debt, and you're trying not to take out any more debt. You're definitely not buying fixed assets, right? You're just trying to survive through the winter until April, right? When our cash starts to increase in March, April, right?
I love this. This is so great. I'm gonna pause you
Yeah.
real quick. So
Yeah.
you're about to go into it, and I don't want to rush you there if you're gonna
Mm-hmm.
go there, but now
Mm-hmm.
that you're saying that,
Mm-hmm.
can you share what these fixed costs look like? Because that could be a good transition to where do I start looking, right? If I'm sitting here going, I don't have the 1.75 times, where do I start
Mm-hmm.
looking at? What do I start looking at to cut? I don't want to jump you ahead, but if
No,
you
no,
weren't gonna
let's
go there, I want to go there real quick.
Let's get into that. Let's get into that. So, one of the templates I shared with you guys that you guys can, Travis, your team, that you guys can share to whoever, this is just a simple prometric analysis. Now, again, my clients, you guys have this in your monthly financials. It's the prometrics, which you guys are familiar with. I'll just zoom down real quick. It's this chart, right? But if you don't have those, or you want to calculate it yourself, or my clients, if you guys are changing things drastically and you want to set up a budget or something like that for next year, a simple budget, you can, I'll use this screen. You can plug your information in here, trailing 12 or something like that, and it will automatically calculate what is okay that you don't have to worry about and what do you need to spend some time in to improve. Okay, this will do that for you. Both of these tabs, depending on what you guys are sharing, both of these tabs will do that for you. What I like about the one that has the with budget in here is it tells you what it should be, right? So if your sales team's payroll cost with taxes is 339,000, we know that you are actually better than the target, and so you actually have a budget of $364,000 to spend on those particular line items. But if you see anything that's red, then we know that we have to dig in further, right? So total overhead costs, all of these overhead expense line items, there are three that we can budget for you knowing industry standards. One is administrative and owner payroll, right? So if you're taking way too much payroll as an owner, you're taking more than what it would cost for someone else to do your job that you'd hire in, right? You might be gluttonous in that area. You might need to improve that, or you might be okay, but you got to plug it in and understand if you're green or red. Advertising, we never want to see more than 7% of total sales going to advertising budget. Again, it doesn't mean you should reduce your advertising spend. It just means you need to kind of improve the outcome of it. Insurance costs, the same thing. We never want to see more than 5% of total sales going to insurance costs, even if you own all your trucks, okay? And then every other overhead cost is lumped into other overhead. So that's really where you have to have a good P&L where you can jump down. Instead of scrolling, I'm going to jump down this way because I think it'll be faster. Where you can jump down and look at your overhead costs, which is everything under truck repair and maintenance, and you can start seeing, are there certain things in here I can clean up, right? Are there certain line items? Am I paying way too much in my warehouse costs, right? Prime example there. Your rent should absolutely be paid for by your storage. If it's not, you're eating into your earnings because it's not, right? So that's just a simple calculation. Your storage should always be more than the cost of your rent. But what can we eliminate? Sadly enough, I have a CFO client that we were talking with that had company benefits, and it was either the company goes under or we eliminate benefits. That's our options, right? And as CEOs, as entrepreneurs, those are sometimes the hard decisions we have to make. But when you know these metrics, when you know these numbers, you can realize I'm green on everything except for this. And if I want to survive, I've got to cut those things, right? So,
And I got so many questions.
Mute, so.
I don't want to interrupt you go on a roll, but I got questions. Yeah. I think they're awesome. All right.
Yeah, please.
So you're kind of talking about this. You're like, hey, we can cut this.
Mm-hmm.
What if you're in the green? Justine, if I'm saying that right, says, what if cash could be used to invest in things like a truck instead? Is that better? She says, what if?
Okay.
That what if the
Perfect.
cash could be invested in things like a truck that could get us to that cash balance faster as we grow? With another
Mm-hmm.
question of like, well, what if I have this cash? Should I start paying down debt during
Mm-hmm.
this time, or do I wait for a different time to do that?
Okay, so we never want to get beneath the recommended minimum cash balance. Okay. And the reason we never want to get beneath there is because you may have opportunities that present themselves and you want to have the cash to do it. You also, especially now, we're going to go into a time period of probably cash degradation as opposed to an increased cash flow. And so we want to make sure that we have plenty of money to be able to cover payroll costs and cover all those things. Even if you have excess of this cash balance, we may not recommend buying an asset right now. Maybe in the spring. Let's keep our cash balance to the spring where then we know we're going to be fine. We're on the upward trend. We have more than the recommended minimum cash balance, and we can put cash down on a truck and buy it. Now cash, that's where this snowball begins, where you can really start making cash, having minimum debt, but using earnings and cash that the company earns to reinvest back in that company, right? So again, 30,000 foot view, we're looking at this recommended minimum cash balance, 1.75 times the average overhead, as a threshold of, can I buy those fixed assets, or should I just keep chugging along, maybe even leasing some trucks for a time until I'm 100% confident that I can buy cash or leverage debt, maybe not 100% debt on a truck, but get a 50% loan on a truck. Again, make sure we don't go underneath that cash balance so that I can have that truck and increase my revenue, but not be dipping into to further reducing my regular recurring cash flow by having loans and things like that, right? So we say if you're under that recommended minimum cash balance, your only goal is to get there. If you're over it, if you have $65,000 in cash versus the $61,000 recommended minimum, what I recommend, put it on debt if you have debt. If you don't have debt, then either save it until you have enough to put down on your next capital purchase. Like if you need a truck, let's be saving for the truck. Or if not, take dividends. That's why we have companies, right? That we want to make cash. We want to be able to take money out of the company. And so if the cash balance is healthy, then you're more than welcome to take dividends. But if it's not and you take dividends, that's when you get into trouble. Right?
So if I'm a simple man here, so it's like you're
Mm-hmm.
running through going, look at your fixed overhead costs, times it by
Mm-hmm.
1.75. That's your goal on cash. Goal number
Mm-hmm.
one, you've hit that. Now goal number two can be a decision of, hey, I could take some dividends, I could pay off debt, I could focus on reinvesting into the business, per se buying another truck, as long as I'm not using debt that goes above that 15%. That's now kind of a business decision I can make from there once I hit that cash balance goal.
You got it. You got it. The CEO, any CEO, any true CEO, your job, your main job is you are the steward of capital allocation, right? You are the steward of what we're
Love
doing
that.
with
Love
our
that.
cash, right? And so if you decide, hey, I got a healthy cash balance, I'm going to take money out of my company, you are not stewarding your money well. Now there is a time to take money. You know, take draws if the company's healthy and you can. Absolutely. But you are sacrificing something, right? So how much are we willing to sacrifice into the future to take draws today? Right. So again, what we say is when we're over that excess recommended minimum, okay, first thing I'm doing is buying assets cash, right? Especially if it helps me mitigate rent or lease costs that I have that's directly going to the bottom line, that's awesome. The next thing I'm doing is paying debt if I don't need any capital assets and if I have debt that I can pay down. And the third thing that we want to do is take dividends. That's the last thing that we want to do, right?
Okay.
Does that make sense?
Last thing you want to do. Okay. Yes, that makes sense. That's helpful. Now, let's just say I'm sitting here and I'm going, Brock, you have all these high in the sky ideals. I'm not at that 1.75, but I want to get there.
Mm-hmm.
Can you show us on one of those P&Ls? Like, what are you
Yeah.
looking at for fixed overheads? What are some of the easier things you can do to try
Mm-hmm.
to change that? What are some of the harder things? What are some creative things that you've seen?
Mm-hmm. Okay. I'm gonna go down to again. I shared this prometric analysis with you, and you're more than welcome to share it with
Yeah,
whoever
we'll
you
give that
want.
out for
Yep.
$500 per person. No problem, guys.
There you go. There you go. One, if you're looking at this and you find something that you can improve, absolutely improve that, right? And I want to show what that looks like. So if we take these percentages, again, this is the same thing, it's just on a trailing 12. If we take these percentages and we put it into dollars, right? Our business is dollars, our business isn't percentages, it's dollars. We now can look at this chart, which is the same exact thing. It's the same exact chart, same exact, line items, everything, except it's in dollars versus percentages. And we can see where this company is making money and where it's spending money, right? In a simple 30,000 foot view to understand this, right, is any company can only spend 100% of its revenue, right? You have $100,000 in. If you spend more than $100,000, you lose money, right? So all we did was we said, okay, well, we want to keep 10% for ourselves. So out of the 100% of the pie, 10% is for us. We're spending 90%. And then we break that 90% into various targets. So I'm selling my secrets. Anybody can produce your own metrics in this manner, right? We just look at moving companies all day, and this is what we see as the target for a company that wants to do 10% net operating income. But if you add up these targets, it adds up to 90% because we want to keep 10% of the pie, right? So if you run this scenario like this and you can see where you're potentially bleeding money, then this is where we go to look to understand where we can save money, right? Truck lease and rent for this company, for example, it is, as long as their insurance is okay, as long as they're, here's another target. We never want truck repair and maintenance to be more than $7,000 or $7,500 a year. Okay, that's another metric for you guys. As long as we can keep maintenance costs down because we have a good mechanic we can rely on that's close, as long as we have the money to be able to buy trucks, it's very easy for this company to increase its cash flow by buying trucks when it has the cash to do so, because we can tell that the truck lease and rent is a little over what it should be. And again, universally from the report that, again, I can share the lease versus buy example, it's almost universally better to buy versus lease. Okay. So anyway, we can divulge what we need to change by looking at these metrics to understand what's red and what do we need to improve, right? There's also trade-offs. As an entrepreneur, there are trade-offs. This company, for example, is paying, say, a little over 8% in taxes and such, a little over 8% of its sales to its salespeople, right? And so if you have a company with a great brand, lots of leads, and you can get away with paying 5% of sales to your salesman. I know a company that pays 3% of sales to a salesman, and they're very large and they have great leads and such. They are pocketing net income more than anybody else because they can pay their guys less per sales than anyone else, right? And so
can I just pause you real quick on that?
Yes.
I'm so sorry. I just want to make sure.
I know I'm throwing a bunch of numbers out.
No, it's so great. Well, I just want to lean in on something that you said that I have always been saying, that it's kind of cool to hear and as an encouragement. Yeah. I do believe, and it seems like you are saying this, the bigger, the better your brand is, the more valuable your brand holistically to the value to the market, the more you actually can become efficient, because you're not having a hard sell, let's say with salespeople. So you don't need to pay them as much commission. You have the ability to pay a little less because people want to work with you, because there's so much snowball effect happening. There's so many people wanting to work with you. And I think that's actually something I've been saying. Sorry, Joey, I don't want you to feel like I'm trying to pay you less, but like as Rotate Digital's brand grows and the value to the market grows, I really do have the option to be more efficient on my sales commission, and because people want to work with us, and I don't need that salesperson to be I wouldn't say as good, but just they're coming. There's more coming to us. So you're agreeing with that kind of concept here?
100%. One of the analyses we do whenever we're looking at a company's ability to increase rates is the percentage of leads they receive from repeat and referral business, right? For a company that's over 5 years old, I want to at least see 40% of their leads come from repeat and referral business, right? And your tolerance for increased rates on repeat and referral business is substantially more than your tolerance for leads you buy, right? Whenever somebody refers me to a company, I'm not. I'm probably a bad example because I'm an easy sell. But if somebody refers me to a company, usually I hardly even care what the price is. I mean, if it's insanely out of line, okay, I'll understand that. But usually it's like, you know what? I know I'm going to have a good experience because this guy that I trust had a great experience. So I'll just go with them, right? They could be 10% more than someone else, and I'm not feeling it, right? I'm not changing my decision because I have that proof, right? So brand over everything. I totally agree with you, Travis.
Awesome.
Yeah. Let's real quick. Okay. So stemming from this, let's talk about cash flow. Let's talk about, so I gave you the 30,000 foot view of the number to calculate your recommended minimum cash balance. Okay, great. And again, my clients, you guys have this, but how do we get more granular to try to understand and calculate what are we actually going to be burning through this winter? Okay. And it goes deeper than you might think. Okay. So I just created a simple scenario to understand how we can project what we think is going to happen.
Can you zoom in maybe one more click on this one?
Yep. Let's go to 150
Okay.
because I think that should be fine.
I thought it was 1.75. Just kidding. All right, my jokes are bad.
That's going to be too much.
I'm sick.
Oh, hey, you know what? Let's run with 1.75. So here's just a quick example. This is a net operating income of a company. Okay. And this is where we're going to get into what's the difference between cash flow and net operating income. Okay. Here's a company that has a net operating income from October through March. We're looking at a total of $9,000, $8,900. And if we look at this, it's like, yeah, we're positive. Okay, sweet. We know that as long as I don't spend more than $8,900, I'm probably going to come out, even on the other side of the winter. Okay. The problem is this isn't the whole picture. This is net operating income. And there's a lot of things that are not included in net operating income. Okay. One of them being notes. So here's an example of a company that has a few different notes. Okay. Debt obligations.
Okay. Thank you.
Yep. I'm sorry. Debt obligations.
I think Apple notes when you say notes. So I'm just making sure we're all here.
Yeah. Debt obligations, leverage. And that does not show up on the income statement, on the P&L, which calculates the net operating income, NOI. So let alone do we have to realize.
And Brock, real quick,
yes.
Why? I'm sure you all know, but just help me out. Like, that makes no sense. I'm spending that money. I feel like that should be on my P&L. It's lost money. I need to know what's happening. So explain maybe why and how you solve that for an entrepreneur who's sitting here going, man, my P&L can look really good, but then if I'm not paying attention to notes, quickly kind of share on that and then you go on.
Okay.
That okay scares me that it's not quick, but okay.
So the reason that it technically your interest expense does show up on the P&L, but a lot of these payments, a lot of the percentage of this payment, $842, for example, is principal on the truck, right? And principal is equity. Right? Like think about when you're paying down your house, right? You have a mortgage payment. Some of that's principal, some of that's equity. Some of the principal is not an expense because when you go to sell that house, you're going to get that principal back, right? Which we call, I guess if you sell it for more, it's a capital gain, but you're getting that investment back when you put it in, right? It's a good investment. Same thing with trucks and most loans, as long as it's a note with collateral, right? These cash notes and things with no collateral, bad news. But if it's a truck, you're paying some of this payment and some of it is going on to the value of the truck, which eventually you will resell, right? And so that's why a lot of these payments are not on the P&L because it's not an expense. You're paying money, yes, but you're just paying money that is delayed because you didn't buy the truck with cash. Right? That's basically what you're doing. Same thing with buying a truck in cash. If you buy a truck in cash, that's not hitting the income statement. I'm not even going to go to the cash flow statement. That'll just confuse everybody. So to think about how this cash flow works, we start with the profitability of the company, but then we have to start subtracting the cash payments that we're making that don't hit the net operating income, one being those notes. Okay. So if we have this example, again, we said that $8,900 is probably what we were going to end up with in the spring, but in reality, we have all of these note payments that we're making. And so instead of increasing our cash by $8,900, we're actually losing a little over $10,000 now when we take into consideration these debt payments, right? So now we can't just rely on what we anticipate an increase of cash flow is going to be from the net operating income. Not only that, but wait, there's more. Now we have draws. So if you are now drawing out equity of the company through an owner's draw, that doesn't hit the income statement either, or the P&L either. So that, again, is just you siphoning off value of your company. And the more value you siphon off, the worse your company's financial position, right? Or the equity you have in your company.
And real quick, going back to the notes real quick on uh where is that here? Yeah. So go back one more. Yeah, right here. So this says 5,246. That says 1,000 in the negative. Is that just because now you got the NOI being applied to it?
You got it. You got it. So let alone we lost $3,100 in net operating income. We also had to pay an additional $3,200 a month in loan payments. And so our cash is actually now negative.
So that's your blue line's cash trend. Okay, got it.
Yeah,
Okay,
this
move
is
on.
cash trend. Yep. So then we go to draws and we say we're taking $1,000 in draws a month. Now we're at negative 16,000. So we thought we were going to be 9,000 in the positive through the winter. When in reality, we're 16,000 in the negative. And that's where a lot of moving company owners get tripped up, right? And again, that's why we go back to, we want to look at what the average overhead cost is, and we want to have 1.75 times that, $61,000 in October, because we pretty instantly drop beneath that recommended minimum, right? If we ended October, or we started October with that recommended minimum cash balance. If we started October with that balance, we already got beneath it at the end of November. And then we're digging in this hole more and more and more to the point where we've burnt through $16,000 of that recommended minimum. So
and that's why you're saying start in April, because you got to build that through the summer, set that aside, knowingly, purposely, with intent, right? Set that aside, build it up, set it aside, because you may look, if you scroll up, you may look at your P&L and go, oh, look, I'm only, October, I'm 8,700 positive. I'm only down 3,000 in November. That's what you may see on the P&L, but you're not factoring in, I got debt payments. I've got a draw that I rely on to live my normal living life. That's the future looking ahead decision and intentional decisions that you got to be really thinking about come March, April.
You got it. You got it. And again, that's why we set that recommended minimum cash balance, because that's the minimum threshold. So if you get into, say, September, where we're at now, and you have $100,000, you think it's a ton of money because it's $100,000. That's a lot of your earnings. Well, if you go out and buy a $50,000 truck, you're now beneath that recommended minimum, and you're going to burn cash through the winter, and you might end up having some sleepless nights because you got to shuffle cash around for payroll. And also just remember, a company of the scenario that I used, a company of this size on a biweekly payroll is running $30,000 in payroll, 40,000 in payroll. So if you're only at 61,000, you're burning through most of that in just one payroll, right? So when we set that as a minimum, that is a minimum, or else you're just going to be stressing, and we don't want that, right? Then you make bad decisions. We don't want that. But this is a scenario on how you not only should be looking at your net operating income through this winter season, but you should be looking at your cash flow, which is debt payments and draws. And then I'll real quick just jump into what that cash flow looks like, so you guys all know. Even if you're not a client, probably the last financial statement you'll receive in a financial statement package is going to be the statement of cash flow. And
I'm going to pause you real quick. So to kind of sum up, P&L alone can be very misleading. As an entrepreneur and an owner, the P&L alone can be misleading because you're not taking in owner withdrawal, debt payments, etc. So it can be misleading you in your decision-making process. So to help your decision-making process, to give you more clarity, to help make better decisions in your business, this is where we're going to the cash flow now document. Okay.
And on that thought, let me jump back in here and say, if we were a good boy and all the assets we bought were we bought with cash, now we change from a $16,000 cash loss, and let's say we don't take any draws, we jump from a $16,000 cash loss to an $8,900 cash gain. And we're in the business to make cash, right? That's why it's so important to be having equity in your assets, so that you keep the net income. If you have debt, you don't keep all your net income. Or if you take draws or equity out of the company, you don't keep your net income.
Yeah, and that target cash balance, that needs to be the same for every month. So every month I need to be looking at having $61,000 in the bank account as a goal.
We used to do that on an annual basis. We used to review for advisory clients. We used to review the trailing 12 in July and give an updated recommended minimum cash balance in July because we want to know what that balance is while we have the cash in the summer season, right? And then we know what we can and cannot spend. Now we just include it in our financials because it's a simple calculation, and we can just jump in here and every month change what that recommended minimum cash balance is. It doesn't change a ton, only because it's a trailing 12, but every month for us, it does update now.
So very particularly a good CFO, fractional CFO, bookkeeper, there's going to actually be some changes, but on an overall basis, it's going to be fairly close. And so if I don't have that CFO just yet or that bookkeeper just yet, some kind of target number, roughly speaking, if I can just keep that for the whole year, is a great place to start.
Yep. If you look at, let's just do this. If you look at your P&L, if you have an accurate P&L, first and foremost, if you have an accurate P&L and you get to December and you look at your total annual expenses, let's say it's let's say it's like $500,000 in overhead expenses, right? Divide that into 12 months times 1.75, and that recommended minimum cash balance is 73,000, right? That's a simple way to do it. Okay. Now again, the more you dig into these numbers, the more we can say, all right, maybe we don't need 61,000. Maybe we can get away with 52,500. Maybe that's the target. And now we have that much more dispersible cash that we can reinvest in assets or pay down debt and stop paying interest on that debt because we can utilize the cash, right? The more granular you get in your review, the better, right? And man, I'm eating up time, Travis. I'm sorry.
No, this is good. And I Brock's not paying me to say this, but I will say this right now. Like I've had a few years ago where I wasn't running this and knowing this very well. Next thing you know, I have my best month ever, followed by my worst month of net of loss of cash. And so if you're sitting here today and your CFO, fractional CFO, or bookkeeper is not having these conversations holistically with you to help you grasp these numbers and help you make better decisions, that can start being your yellow and red flag to go, maybe I need to level up the people I work with to help me make better decisions so I can do this. And Brock, obviously you do a phenomenal job. And so I really do recommend your services. Now you can pay me later on the side for saying this, but, okay. but really, if you are having a bookkeeper that is just sending you a statement every month, and that's the end of the conversation, you better be paying dirt cheap for that, because that's dirt cheap work. Because to get a cash flow balance, to get a P&L statement, that's easy to do. It's the analysis and the decision-making process that is what you want to pay for the value there. So shameless plug, Brock, if you guys aren't using Brock, use his company.
Well, Travis, now I owe you for that, and I owe you for blackjack lessons. So I'm ranking up some debt here. We can real quick. Anybody, again, if you have financial statements, you can look at your statement of cash flow. And just like we talked about, you start with your net income. Now, this is net income, not net operating income. We won't get into that. But this starts with net income. And then you have these adjustments, right? These are accruals and things like that. These are payments for fixed assets. So this company paid $42,000 in January to buy a truck. It's not on the income. It's not on the P&L, but it is cash out of the company, right? They also had a note they received, they had cash infusion, and so they ended that period increasing $7,200 or $7,300. But that's how you read a cash flow. It starts with that net income and it reconciles to the actual change or cash increase for the period. That's what it does. It reconciles to your bank account balance at the end of the month.
Yeah, and that is ultimately net income. Then you've got your credit card payments and what is owed on your credit card here, then your debt or your notes, right? And then and then what you've pulled out of the business in terms of pulled out equity. Then you've got your net cash flow, which is really what's happening to your bank account at the end of the month. I know I just repeated everything you said, but
yeah. Well, and while I can even go to this, while this company had $286,000 in profit for this trailing 12, They had cash flow increase of $52,000. So not near what their profitability was, but they did buy, $256,000 of fixed assets, right?
That's beautiful.
So yeah,
And this is a perfect place. If you guys are hearing this and going, I'm still a little touch confused, put the question that you're confused in right now. This is a perfect time for us to address it. If you've got that question, other people do. Brock, I want you to kind of continue with what you're doing, but I do have a lot of questions. So when you're ready to wrap up, we'll wrap up and go to the Q&As.
You know what? Let's do that now, only because I fear that if I keep going, I'm gonna dig down some deep rabbit holes. So I better
Well,
keep moving.
it's all good deep rabbit holes.
Yeah.
There's a reason why you're now our first guest to come on twice to a webinar, because we get
Okay.
so much valuable feedback and we get so many people
Awesome.
to go, this was so helpful. We're not going to a community college to learn this information.
Yeah.
We're going to some random person on YouTube or our buddy down the road who probably knows, to diddly squat,
Yeah.
and so to
Yeah.
get it from you is so valuable. So
Well,
go ahead.
and that is also while and my clients that are on this know this, but that is why we produce these dashboards and things too, because you don't like I want you to know what this recommended minimum cash balance is and what it means. But if we can be a trustworthy source to calculate it for you, I don't want you to have to learn how to do the accounting. We'll do it for you, and then and just give you the numbers to use. And sometimes I have meetings with clients, or we have advisory clients that we help hold their hand through it, right? Because as you grow your company, you're doing $1.5 million, you're doing $3 million in revenue. 1% change from an advisor can really make a big difference. So you don't have to be a financial guru to understand this stuff if it can be in a legible format that you can use. So anyway.
Beautiful. Well, before we move into questions, I'd love everyone to say thanks to Brock. Give him some encouragement for coming on again and going through this stuff. Throw it in the chat. Let him know that you are appreciative of his time, of the value he gave. He's giving some proprietary stuff that you only get when you pay a lot of money or a decent amount of money to Brock, And so I want to just say thank you for doing that. Let's move on to look at that. A lot of great things.
Awesome.
I didn't see anything about the host yet, but we'll wait to see
Yeah.
if those come in. Let's go. Reese has got some questions while we're on the topic of debt. Reese says the no debt in excess of roughly 15% of annual sales. Is that just for new debt or all debt, including current debt?
Okay. We say that's for all debt, but when you start getting into warehousing, it can fluctuate a bit, right? And that's a whole conversation. It really depends on, what your long-term goals are. So what we mean is we mean long-term debt. So not short-term debt either. Obviously credit card, no, don't have that debt, but predominantly trucks in the moving industry.
Okay. Let's move on to the next question. Oh man, we got some really good questions here. So here we go.
Good.
Reese says, would love to hear some strategies on adjusting owner salary to meet target percentages. What is some wisdom to think behind that?
Okay. So for more than one reason, what I want to do is recommend what it would cost for you to bring someone in that's pretty much going to do your job, right? That's what I want your payroll to be. Especially in the reason I say multiple reasons is, one, if you're an S corporation and you get audited, they're going to be looking for a reasonable wage. Now, what is a reasonable wage? Well, you're going to have to argue that. You will have to argue what a reasonable wage is. And if you're taking $15,000 a year, they're going to say, not reasonable, right? So one, for the S corp, you need a reasonable wage. But two, for metrics, if you're looking at your numbers and you have you and two other admin, and your administrative labor payroll, which includes owner's pay, is 15%, then you're too admin heavy, even with you in it, as long as you're taking a reasonable wage, right? And that should be a light bulb to you that goes off to say, I say this all the time, the biggest cost of any company, and it's invisible, but the biggest cost of any company is the cost of potential, right? And so if you're paying 15% of sales to administrative payroll, you have a lot more potential that those administrators can produce for your company than you're currently using. So that's where, as far as owner's payroll goes, pay yourself a reasonable wage, and then any draws you take out, just remember those draws, you don't have to pay FICA on it. So Social Security and Medicare. So that's beneficial.
Yeah, and I would, and shoot me down if you're wrong on this, but I would say a really good tactical way to start this is look at what your month looks like. Maybe start with a time audit of your week. What are you spending your time on? Is it sales? Is it admin work? Don't try to categorize it. Just write what your time is spent on. Then go back through and go, well, if I were to find someone really good to help me get 80% of this done, what would that cost on an hourly basis? And start working backwards to go, where's my next lever of what I should be paid for my work, and or where can I now delegate, got somebody else.
And you know what, with that too, and I was going to say this, and then somebody put it in a comment. If your business is under 2 million and you're still in sales or something like that, what we try to look at it holistically. And if you as an owner are doing sales as well, or you have some admin that are doing admin and sales, we will holistically look at the sales labor metric and the administrative payroll metric. And so together, we don't want that to be more than 17% of total sales. So if you're doing both, 17% is the target for all those things.
So admin plus sales together, if it's kind of the same or they overlap so much, you're going 17% is a rough target for, you said under 2 million or anything above 2 million?
Well, usually companies that are doing more than 2 million, the owner isn't involved in sales day-to-day. So yeah, if you're involved in sales, then then combine them if you'd like. But again, we really want that. We really want them broken out because we want to understand where our problem lies. Like if you're the owner, but you are truly doing 100% sales, and you're in admin payroll, but you're already paying 8% of your sales to your sales team, there's inconsistency there, right? There's glutton there because you guys are spending way too much money on your sales team, even though the metric is not that far out of line. So again, garbage in, garbage out on the accuracy of the numbers.
Okay. And is sales payroll considered admin, or did you just kind of answer that by going, it depends if you're combining?
Yeah, it's different. It's different because we put sales payroll as a direct cost, whereas we put admin and owner salary as an indirect cost. And I'll say again, on an 1120S, a tax form, they are separate, especially owners separate.
So sales payroll gets separated out and is not included in that expense line item. And one more question following on this is, then for this income calculation, are we just including moving income, or do we include income coming in from like storage, let's say?
We include it all, but if your storage is substantially material, like you do a ton of military moves and you have a lot of military revenue, then these target metrics are going to be off. If you're predominantly doing van line revenue, right, these target percentages are going to be off. It's just a totally different business. You're usually your marketing budget is much less because you're getting the leads given to you, or your costs are much different than a regular moving company. So we include storage in that as long as it's not something that's 50% of your revenue, if that makes sense.
Okay. Sean had a really great question that were words way over my head here. What is the importance of overhead absorption rate, fixed expense cost to cost of goods sold?
Okay, love that. Okay.
Yeah. Fancy words. Can we talk about it like a third grader for me real quick?
Okay. If it's the Ray I'm thinking, is it RAE? I bet it's with Sean.
Yeah.
If that's the case,
overhead versus absorption rate, overhead versus fixed. Overhead.
I think I know what they're asking. Okay, so again, we've got this whole pie of revenue. It's 100%, right? We can't spend more than our revenue, or else, bad things. Let's assume we want to keep 10% of our sales, 10% net operating income. That means we have 90% left. The way that we do the accounting, we never want to see less than 45% gross profit margin, right? Which means 55% of sales goes to direct costs. So you have sales, 55% of those sales go to direct costs, meaning you're left with 45% of total sales. That's gross profit margin. Okay. we're only left with 35% then, right? And so that's why we say your overhead expense should be no more than 35% of your total sales, just purely due to the available allocation, right? If you're a crazy company and you guys are running at a 55% gross profit margin, then you have the ability to either capture more net or spend 45% of your sales on overhead without dipping into that 10% net, right? But the way that we do it and the way we recommend most moving companies are doing it is of sales, 55% is direct costs and 35% is overhead, leaving 10% net operating income.
Okay. Awesome.
Yeah.
Okay.
Great question.
We've got
Great
we've
question.
got some really good questions coming up, but I'd like to take a pause real quick here. Again, Brock, we'll share your information at the end of this webinar. I'm gonna do it. I'm gonna do an ask here. If you guys are finding these webinars valuable, I want to do an ask here. I'd love for you guys to either go to Rotate Digital on Google and review us for the webinars, so that we can use that on our landing pages to get more people to sign up, or B, take a photo, post it on Instagram, or send us an email sharing your testimony about how valuable this is, because we want more people to see that it's worth spending an hour out of your day once a month to come join this. So that could be something that I really, really would appreciate, whether it's a review on Google, whether it's an email to us on your testimony. Please just take the time of today and send that over to us so that we can help get more people on and have our team encouraged for doing this. So that's my shameless plug. Thank you so much. Let's go into these other questions. What financial metrics? This is going to be the fun scaling. How do we balance now? We got metrics and we've got finances, and how do we merge this together and collide it with business decision and growing? What financial metrics should guide decisions about expanding into maybe a new service or a new service area or adding trucks or staff? How do I start pulling this together so it's not purely just a subjective emotional decision, and I use finances to help guide that decision? Can you help us walk through that?
Love this. And I got to rope you into this, Travis. So financial metrics are going financial metrics, gross profit margin, for example, tells us if the ship is going in the right direction. If you have a garbage gross profit margin, then it makes no sense spending money on advertising, because the more money you make, the more money you're spending in a very poor trend, and it takes a lot more revenue to make any money. So one, let's say you have a strong profit margin. Great. Two, let's say you're 10, 15, 20% net operating income. Okay, that's fantastic. The next piece of this then is how is my market reacting to my advertising spend, right? If you are super strong on organic and a lot of your leads are coming in through organic search, then you're going to have a lot easier time expanding into the next town and using the leverage of that high ranking, right? I literally just talked with a moving company about this last week. They've kind of, I'm going to say they've kind of reached a peak. They've put a lot of different money into a lot of different marketing sources, and for their area, it just hasn't had the return that we wanted to see. And that's where I would say, you know what? It could help to expand, and expansion can be very, very, very profitable. But they were thinking, well, what if we go like South Texas? And I'm like, totally different market. You have no idea how your marketing is going to do. Definitely not. But if you're going to go an hour north, or a place where your moving trucks are going quite often, then it makes massive sense to start a new location, especially if you can capitalize on having like a central call team, a central call center where they can service both locations. Now your overhead cost on that location is substantially less. But I say all this to say, one, the metrics have to be profitable first.
So got to be profitable.
Got to be profitable. Don't look at expansion until you're profitable where you're at. Okay. And then number two, figure out what your best ROI marketing source is and leverage that into a new location. So that's where I say expansion. When you're probably never going to totally cap out your market, but you're going to run into a point where the spend on your marketing starts having diminishing returns, and then you can look at another market and start putting marketing dollars in that market and not reach that cap of diminishing returns. Travis, would you agree with that, or how would you add to it?
Yeah, and I would even add on that expansion, I would agree that sometimes expanding doesn't mean a whole new location where you're operating out of. Expansion could sometimes mean just 15 minutes north. If you're a company that can get reviews, review is a currency for Google Business Profiles. Just going 15 minutes north where your current Google Business Profile cannot reach, you can open up a new profile, you can open up a new office space for $500, $700 a month, gain reviews, and get a whole new market of people. And you really have not increased your fixed costs more than $500 to $1,000 a month because you're operating out of the same team. You're dispatching trucks out of the same location. And so expansion doesn't need to be a whole new city. Expansion can just be 15 minutes away. Great way to expand. We also see a lot of times people who have their Google Business Profile at their warehouse. Expansion just means in a different area because your warehouse, roughly speak on a bell curve, is located in an area that is usually all warehouse or lower income, and they're just around your area are not the people you want to be marketing towards. And so you've got to expand by opening a new location somewhere away from a warehouse district and going into a city that maybe an office space makes more sense. Does that make sense?
Mm-hmm.
That,
Interesting. Yeah.
so that's where expansion looks like because you look around, we've got people who here in Phoenix, they have great locations for their operating of their business, but the warehouse area is not their clientele. So they've got to go open new locations 10, 15 minutes away. That's what expansion can look like. It doesn't mean them opening a new location in Florida, which everyone wants to do for some reason. So
Yeah. Yeah.
yeah,
It's a
so
hot spot. Yeah.
that's my insight on there. What would you say then? I've always said you never want to take on debt to increase marketing. Would you agree with that, or is there some kind of wisdom around here? Here's when you do it.
100%. 100%. And also I would say, dare I say, um, the first the it goes along with brand. The first marketing source is you. And so if you're doing, if you're just starting out or you're a year into it and you haven't, really crushed a location yet, you're the marketing source, right? And then you really need to think about building up that business profile because that's where most of the search comes from. You can pay for LSA and things like that, but first you're going to want to make sure that organically you can get these leads in so that you don't have to pay for them. Google's expensive, but if you're getting the organic leads, it's very, very cheap. So I guess I would say the first and foremost, people underestimate the value of building their own brand and hitting the pavement.
Mm-hmm. Yeah. Oh, 100%. They
Mm-hmm.
underestimate the human to human conversations, the
Yeah.
human to relationships. They want to do the easy route and just spend money on SEO, open a Google Business Profile. But the companies that are winning organically, that are winning on this, they didn't ignore this other side. And I think that's a
Mm-hmm.
big thing. I would argue that most of our clients who end up leaving us, who maybe had a missed expectation, they want to go one or the other. And the companies that win want to do both. It's a piece of the pie, not the only pie I eat. So
Mm-hmm.
that's very important is you've got to run holistically a good business or any one of these channels are not going to work out for you. And it's just not a holistically good business decision.
I can see that. That makes total sense. Yeah.
Cool. Well, we've come to the end, everybody. Brock, thank you so much. I
100%,
think
man.
I think this is so helpful. You get to
Good.
combine P&L finances, but combine it with how do you make good business decisions. And our goal is to incrementally increase the value of our business, make better business decisions, and this is all helpful to do it. So, Brock, if I'm sitting here, I'm a moving company owner, I don't have a good CFO or fractional CFO like you, I don't have a good bookkeeper. Can you share a little bit of information about your services, whether it's
Mm-hmm.
cost or what you do, and then how to reach you? Well, that would be a great
Yeah.
thing to share.
Yeah, so ProMoverAccounting.com, the book of meeting goes to me unless it's tax related, then it goes to a tax CPA here on staff. But bookkeeping is the foundation of everything, and so we do bookkeeping for a lot of clients. And then when somebody wants their hand holding on projections and budgeting and forecasting and things like that, the next natural step is our advisory services, and really the bottom line of the advisory services is quarterly meetings, doing annual budgeting and things like that. And that is 100% available to almost all moving companies. But then when you're doing over 3 million a year in sales, that's when we start recommending fractional CFO. And that's just going to be substantially more weekly cash flow forecasting and CapEx planning and like much more intense stuff. I got a guy that's planning a 5-year exit And just, what are we doing now to plan for that? Are we okay? Looking at some of these exact same metrics we're looking here, what are we doing with our cash? And we're helping the management team through that. So, ProMoverAccounting.com is the best way to get out, reach us. And bookkeeping is always what we recommend starting with. And then after that, advisory and fractional CFO and tax naturally is always on the back end. So.
Awesome. You heard it here, guys. Again, Brock's great. I put my recommendation for Brock. They do a great job. Thank you all for staying past the time that we said. I hope it was valuable for you. I've got a baby's doctor appointment to run to. We've all got work to go to. Everyone, thank you so much for being here at Rotate Digital's webinars. Thanks for being here, Brock. I appreciate it. And we will see you all next month at our next webinar. Stay tuned and be on the lookout for emails on what's coming next. Have a great week, everyone.
See you guys.
Bye.